And with that, it's my pleasure to invite John Larson to come up to the podium. John is the Vice President for Mid-Continent Operations at Bonanza Creek, which is very active in southern Arkansas in the oil exploration business. John lives down in Sugar Land, Texas. Bonanza Creek's headquartered out in the Rocky Mountains in Denver. And John, we look forward to your remarks.
Thank you, French. Are we on? Yeah, okay. Thank you, French, for that introduction, and thank you also, French and Delta Trust, for inviting me to share the Bonanza Creek story with you. I'm going to be sharing with you the investor presentation this morning or this afternoon, and then I'll also be adding a little bit in extra about some of the history we've gone through with Arkansas, since there's a little bit of interest here. Starting off with, this is the official disclaimer that says that any forward-looking statements that I say, anything that doesn't happen, anything that has not happened already might not happen. And you should look to other sources of information besides what I say today and when you're deciding whether to buy from stock in Bonanza Creek. You can find this presentation on our website, which is bonanzacrk.com, and we'll get started. Bonanza Creek is a small, rapidly growing company, oil and gas producing company. We are focused on developing oil from the Niobrara Shale in Colorado, Wattenberg Field, and we're balancing that with relatively low risk infill development in southwest Arkansas. We are a publicly traded company. At the current stock price, we are valued at $1.3 billion. We are traded on the New York Stock Exchange, and we've been public for a little over 1 year. Public float is about 73%, so we have shed a lot of our hedge fund investors that's brought us through the private time. As you can see on this slide, at the end of 2011, half of our producing production was split between Arkansas and Colorado. The company's 3 senior executives have been together for over 10 years through various entities, Bonanza Creek entities. And what we do is we buy old oil and gas fields, and we use modern technology to add value to them. We've also been benefited through some serendipitous things. For instance, the price of oil has gone up considerably since we bought some of these properties, and also I'll share you some of the experience we had in the Wattenberg field. In our experience in Arkansas, we purchased properties in 2008 and 2009 in Lafayette, Columbia, and Union County. We have 4 oil fields down there that we operate. We have a gas plant. And in the last 3.5 years since we put that position together, we have drilled over 100 wells. We have built a gas plant, and then we doubled the size of the gas plant. We have increased our staffing by over 50%. Our number 1 vendor, actually 2 of our top 5 vendors of the whole company are based in Magnolia, Arkansas. The vendors who are not based in Arkansas are staying at your hotels and eating at your restaurants and buying food in your grocery stores. We have spent over $250 million in South Arkansas in the last 3.5 years. And somehow in all of that, we have become the largest oil producer in the state of Arkansas. And I just found that out during preparations for this talk. So if you take the gas and convert gas to oil equivalent, we are the 5th largest oil and gas company operating in Arkansas today. We do participate in the community. We had a steak cook-off team this year in Magnolia. We also have supported children's groups, sports groups, and we have given scholarships to students at SAU. And we also have supported local fire departments in this area. So we're trying to be a good neighbor. One of the bigger problems that we've had is keeping up with our gas processing capability, but also in places where the mineral rights and the surface rights have been severed, oftentimes the surface owners don't have the same financial interest that we might have, and we've tried to be a good neighbor with them as well. So I'm going to move on here in the regular presentation. As you can see, over the last 5 years, our production and reserves have increased significantly, and we have increased significantly, especially in the last, the second to the last bar is 2012's estimate. The official numbers will be coming out in about 2 or 3 weeks. And then the 2013 estimate is the far right. Most of this increase, we have increased the production in South Arkansas by about 5 times in the last 3.5 years. We've been restricted by how much gas we can process and sell. And with a brand new expansion to our gas plant, we do have some growth capability there, but the majority of this growth is happening in the Wattenberg Shale. And this is a comparison of the third quarter of 2011 to 2012. We've doubled our production. We've increased our earnings, or our income, by over 5 times. Our EBITDAX is up by 1.5 times. And this is primarily possible because the price of oil is a major determiner of our revenues. We get 92% of our revenues from oil and natural gas liquids. We only get 8% from natural gas. If you take the oil and the gas and you create a barrel of oil equivalent, we're getting the equivalent of about 68, in the third quarter we were getting $68 a barrel for our oil equivalents, and roughly the cash margin there at that price is about $45. This is company-wide. This is our growth pipeline. We have over 250 million barrels of oil possible out there that might be there in the fields that we currently operate. The green box is the Wattenberg Niobrara B, and I'll get into a little bit more detail what that is, but the Niobrara is a shale, and there are multiple sections of it, and the main one is called the B, and we believe that to be a straight development project. The yellow boxes are projects that we're experimenting with this year, and we've got a lot of help from our neighbors. The blue boxes are boxes that our neighbors are working on, and one of the blue boxes on there is the Arkansas Brown Dense, and we're hoping that Southwestern is able to prove that up, and we have some interest in that prospect, but they're by far the major operator in that play. The other one that's Arkansas is a Cotton Valley 5-acre spacing. Right now we are drilling wells down to 10-acre spacing in the Dorcheat Macedonia field, and last year we drilled 3 wells, and we're going to drill 3 more wells this year to see if we can go down to 5-acre spacing. That would have the effect of almost doubling the number of wells in that field. So for 2013, all of the money is coming from the cash flow that we get from our Arkansas investments is pretty much all going into the Wattenberg field. You can see there we're going to be spending 82% of our capital in the Wattenberg. We're going to drill 56 horizontal wells. These are the wells you've been talking about, or you've been hearing about all over the country. We do have a couple of experimental wells that are going to be drilled. We have 2 that are going to be 9,000 feet long horizontals. The normal standard one is 4,000 feet. And think about that, that's almost a mile horizontal. that we go. We are going to test 2 other benches, and I'll show you a picture of what that looks like. In Arkansas, we're looking at spending about $70 million, and that's pretty consistent with what we've done the last few years. This year, we'll be more focused on wells, and we won't be building a gas plant, hopefully. We'll be drilling 36 wells and recompleting 114 wells, which is almost half of our wells. And we just finished up our gas plant expansion about 2 weeks ago, and so that will represent 2 vertical rigs in Arkansas, and we'll get up to 4 horizontal rigs in the Wattenberg field. One of the stories about Wattenberg is, well, okay, before I get to that, this is a slide that was put together by Credit Suisse, and this is showing the internal rate of return of the basins that all these independent small and mid-cap oil and gas companies are chasing right now. And you've heard a lot of them in the press, but I'll point out that the yellow bar is the Wattenberg Niobrara, and that is right up there as some of the most profitable projects in the country today, and we're right in the middle of it. That compares with the Eagle Ford, in the liquids-rich Eagle Ford, which is the far left, and then there's the Marcellus Shale super-rich right to the right. Now, the bad thing on this slide, from your guys' perspective, is the very far right is the Haynesville Shale, which is really hurt by the low gas prices. There's a comment on there about the Cotton Valley Vertical. That is, in Louisiana and East Texas, the Cotton Valley is mostly gas. But where we are in South Arkansas, we're producing about 75% oil from the Cotton Valley. The Fayetteville Shale is on there on the far, not on the far right, but it's toward the right, and that's why the activity in that play has slowed down a little bit. This is a map of where our field is located in the Wattenberg field north of Denver. And really the thing to share with you here, our wells come on at 500 barrels of oil equivalent after 30 days. If you take the first 60 days, it's about 400 barrels of oil equivalent. The operator directly north of us, we're the yellow, but directly north of us is Noble Energy. And Bonanza Creek did exactly here what they were doing in Arkansas, where we were drilling infill wells. We were merrily going along drilling infill wells vertically. And we noticed that some of the operators around us were drilling wells horizontally. And so we started doing some research and trying to see how that was going, and it looked pretty good, so we went ahead and tried some of our own. And we drilled 4 horizontal wells in 2011. They were so good that that's really what led us to go public at the end of 2011. In 2012, we pretty much abandoned our vertical drilling, and at this point, we are drilling all horizontal wells in this field. Well, we're also waiting for, we're watching Noble in this Wells Ranch area just north of us, because they're testing these long laterals, twice as long laterals as the ones we're drilling. They're also testing 40-acre spacing, and they're testing A and C bench wells as well. So we kindly call them our research department. But there's some other companies there that are active in this play. The one thing that makes Bonanza Creek unique is that we are so leveraged to this play because so much of our assets are in this play. We're trying, because the wells are more expensive, we're trying to do a better job with every time we do a project. And over the last year and a half that we've been drilling these horizontal wells, we've been able to increase the production that we get out of the wells by about 10%. And that's by a number of different ways. One, we've been trying the different number of frac stages, and probably the biggest one is we have been running gas lift valves for artificial lift when we do the initial completion, so that we don't have to shut down a month or 2 into it and recomplete the wells for lifting. This is a kind of a map or a diagram of what the Wattenberg field looks like and what we're doing. The wells have been drilled in this field. There have been thousands of wells drilled in this field vertically over the years. And just here in the last few years, I think it was EOG was drilled the first horizontal well up here and decided that, you know, maybe that would be good and we can get some better production out of that B zone. Well, now we're looking at the C and the Codell, and the Niobrara A and Greenhorn may be out there too. And what that leads to is a play where you're not just going acres sideways, but you're actually stacking up the acres. And so if you stack them up that way, it almost looks like we have over 100,000 acres of opportunity. We do have some microseismic, which is a way of measuring where the fracs go, and we believe that these fracs are not touching each other. Now, that will remain to be seen, but that's, at least from the science, is looking like that that's one of the reasons that has led people to go test these different zones. The offset operators around us are very active here. Besides Noble, we're going to focus on the ones that I mentioned before, the long reach. We're going to do 2 long reach wells. We're going to do 4 Codells. We're going to do 4 Niobrara Cs, see how those work out. And then on top of that, we're going to try a 6-well, 40-acre pilot. The economics of a B, this is a standard economics of a B bench well. As you can see down there at the prices that we're currently at, they are very, very good returns. And we get about 300, a little over 300 barrels of oil equivalent, of which we expect that to be about 65% crude oil. All right, moving to Arkansas. As I mentioned before, most of the free cash flow from Arkansas is being reallocated to the Wattenberg right now. There is a mistake on here for my friends from the South Arkansas. The Cotton Valley that we're looking at is between 6,500 and 8,800 feet. Now, I don't know how that got in the slide, but so we're between 6,500 and 8,800 feet. In addition to our Cotton Valley 10-acre infills, we're testing the 5-acre infills. And we're also looking to see if maybe we can do some of the same things that we've been doing at Dorcheap, Macedonia over at McCamey-Patton. And then we have about 6,000 acres of brown dense. We have 40 million standard cubic feet of gas processing capability. The majority reason for that gas plants is we remove about 9% of nitrogen that's in the gas. We also are able to take some liquids out of it, and that brings you to the economic slide for Dorcheap, Macedonia. We get about 152,000 barrels of oil equivalent from each well, and that's about 70% oil and liquids. New well that would come on, we would expect to come on at about 100 barrels of oil equivalent per day. We have about a little over 100 wells left at a 10-acre spacing, and so then if the 5-acre spacing were to be successful, there would be even more. And that's just at Dorcheap, Macedonia. That does not count going over to McCamey-Patton, or we have some small interest at Atlanta and Beach Creek. This is why we're doing, this is a slide here to show you what the Cotton Valley looks like in South Arkansas. And I've heard this described as a bunch of potato chips layered on top of each other. The sand lenses are very small and we don't see them from one well to the other. And so that's why when we drill a well in between them, we actually are able to find new oil. A couple of things that we've done special in South Arkansas that weren't being done before. One is this pinpoint fracture technology where we go in and frack individual sections. And all these wells are vertical. We don't drill any horizontal wells in Arkansas. And we're drilling and we're fracking very small groups of sands. And we're stimulating sands that had not been stimulated in the past, because in the past they did large fracs. The frac energy went into some of the better zones and left these lesser zones not stimulated. Looking at the financials of the company, as you can see, the top line there is the production increase. You've already seen that in the bar chart. One I'll have you look at here is capital expenditures. We've gone from almost $200 million $300 million in 2012, and we're going up to $400 million in 2013. There is a line there called production taxes that goes to the state of Arkansas. On the bottom, there's an interesting number down there. Is the Wattenberg field actually has a penalty over WTI because there's so much oil in that part of the country. So we get $6, I think that's $6, $8 less than WTI. In Arkansas, we actually get above WTI. All of our oil goes to the El Dorado refinery operated by Lion Oil. We sell our NGLs into the market, and they are actually being impacted by a lot of other NGLs on the market, but they're better than the gas price right now. The cash costs are actually going down as our production goes up. This is cash cost per BOE. So as our production goes up, the cash costs have gone down. And the slide on the right is our realized price. We're getting about, well, that third quarter there is the $68 that you saw before. From a capitalization perspective, we have a target of 2 times a debt to EBITDAX, target of 2 times, and right now we're at 0.9. So we have a lot of financial flexibility to provide funding to be able to continue drilling or to perhaps buy some additional acreage. Sometimes we get questions about our hedging positions and strategy. We have about 40% of our 2013 projected production hedged at between $90 and $100 a barrel. We actually have quite a bit of gas hedged at $6.50, and I guess that'll probably be the last year of that. When we bought the properties in Arkansas, they came with a hedge on them that was at $65, and when we bought the properties, the price of oil was somewhere around $90, and it went up to $150, and every day that it went up, we were losing money on the hedges, and we actually went down to $37 there in 2009, so we actually benefited from those hedges in the end. Mostly the reason we have the hedges is to protect our capital drilling program so that we have our cash flows to drill. So just in summary, we are a true crude oil and liquids producer, primarily in the Wattenberg Basin, but we do have significant production in the southwest Arkansas. We are rapidly growing, especially in Colorado. We have a large inventory of high-value, drill-ready locations with upside potential. We're able to use our cash flows from the Dorcheat-Macedonia field to fund growth in that Wattenberg. We have a very experienced management team with a proven track record, and we have low leverage and substantial liquidity. Thank you very much. I guess we'll have questions later.